Hi everybody, this is Alan Ellman, the Blue Collar Investor. And first I want to congratulate you on making it to Lesson 8 of the Beginner's Corner Information Series on covered call writing. This is our final lesson. Today we're going to show the entire step-by-step process for mastering the strategy of covered call writing. As you recall, the first thing we want to do is form a watch list of the best covered call candidates. For our premium members, we refer to this as the running list because that list is constantly being rescreened and updated. We start with a fundamental analysis, earnings and revenues, and we use three resources: the Investors Business Daily IBD 50, then the Investors Business Daily Smart Select screens, that's the one where we require 6 green circles, and then Money Central Scouter ratings, that's the risk reward screen that we require a rating of 5 or better. Once we've run the stocks through these screens, we then do a technical analysis of the price chart. I have 4 parameters that I use: moving averages to determine trend, MACD and the stochastic oscillator to determine momentum, and volume to confirm the other technical parameters. In addition to that, we use certain common sense principles. Like, for example, we avoid earnings reports whenever we're selling covered call options. We also want our portfolios to be adequately diversified. Ultimately, we want to come to a watch list of between 40 to 60 stocks that are great covered call candidates. This is a comfortable number for most investors. You may want to have a little less or a little more, but for most investors this will work. Now I'm going to show you what a watch list and a screening process looks like. And this is the report that we use for our premium members. And the first part of the report is the stock screen. And what I've done on this slide is highlighted just a few of the screens that we use, so you could kind of get an idea of how it works. On the top left, you see some of the resources that we use. Mainly the IBD 50 is our starting point. So where you see a number in that column, that will give you the IBD rating that particular week. Where you see other, that means we located the stock from other resources other than the IBD 50. Where you see the box that says pass the Smart Select screen, that's the IBD Smart Select we talked about, and that has both fundamental and technical screens. And again, it has to have all 6 green circles indicating each category at the top of the list in terms of the quality of the screen. The third screen to the right that I've highlighted is the Scouter or the risk reward, and once again we require a rating of 5 or better. And the next 2 columns relate to technical analysis. The chart and the price has to do with the moving average. Is it uptrending? Is it moving sideways in a trading range? Or is it downtrending? The column to the right of that is the MACD and stochastic oscillators, which indicate the momentum of that particular price. And finally, all the way to the right, we have earnings report information. Is there an earnings report about to be reported in the current month? So that's what the screening process looks like. Those are a few of the screens we use, not all of them, but I wanted to show you how the process works. And ultimately, it will lead to a watch list, or as we call it for the premium membership, our running list. And there's a lot of information on this running list. The left-hand column, of course, has the ticker symbols of the stocks. The next column is the next earnings report date. We want to avoid earnings report. We've actually highlighted in gold the rows of the stocks that have an upcoming earnings report in the current month, so we know just to avoid those stocks in the current month. Next, we have information on the stock's industry. We name the industry because we want to make sure that no one industry, just as no one stock, should represent more than 20% of our total portfolio. We also give the industry rank, and that will let us know if the institutional investors are rotating into this industry or out of the industry. Certainly rankings of A or B is something that would benefit us. We also have additional information which I discuss in more detail in my books and DVDs, things like beta, which is the historical volatility of a stock. In bullish markets, we want to have high beta stocks because they outperform in bull markets. In bearish markets, we would lean towards low beta stocks which outperform in bear markets. Some of our investors like stocks that give a dividend yield, and we indicate that information also on the running list. And there's a lot more information here as well, but what you see here is what our final running list or watch list will look like after we've run it through the entire screening process. This is certainly something that every investor can do on their own, but if you're looking to save time and effort, the blue-collar investor will do that for you with your premium membership. Once you have your stocks, it's time to go to the options chain to prepare for your calculations. And this is a typical options chain that you see on the screen right now. And for example, if we wanted to sell the $50 call, we would go to the bid column and scroll down to the $50 strike price. And you'll see here the bid is $1.50, the ask is $1.75. So if we put in a market order for, we would get $1.50. If we wanted to negotiate or play the bid-ask spread, we probably could do a little bit better. I'm going to say we should have no problem getting $1.60, certainly $1.55, but we could do better than $1.50 with a 25-cent bid-ask spread. We accumulate this information and then we feed it into the Ellman Calculator. Now on the screen here you see the multiple tab, which allows you to calculate multiple stocks and multiple strike prices per stock all on one page. The information from the options chain is fed into the blue cells, and the calculations automatically appear in the white cells to the right. Let's take a quick look at the last three columns on the right-hand side. The ROE is the return on the option, or the time value of the premium, just the profit. The middle column is the upside potential. If you sold an out-of-the-money strike, as we did in the preview example at the very beginning of this series, where we bought a stock for 28 and sold a 30 call, well, that stock can go up from its current market value up to and past the strike price, generate additional profit that particular month. So for out-of-the-money strikes, there will be upside potential. Now the final column, downside protection, relates to in-the-money strikes, where the intrinsic value of the option premium protects the time value or the profit of that premium. So what I've done is highlighted some of the rows in yellow and some in green. Let's take a look at the top yellow row. That's for Netflix. At the time, the return on the option was 3.5%, and since it was an out-of-the-money strike, you could see on the left the stock price was 75. We sold the 80 call. There was a possibility of an additional 6.7% profit. So there's a possibility of making 10.2% in that 1 month, and you might opt for that stock and option strike if you were very bullish on the stock and the market in general. Now the green rows show stocks that offer no upside potential but downside protection. Those are for in-the-money strikes that have intrinsic value. So for example, if you look in the middle of the page at CTRP, you see that the return on the option with just the time value or profit is 4.5%. Not bad for 1 month. And it offers downside protection of 5.7%. So what that means is the 4.5% 1 month profit is guaranteed as long as the price of the stock does not depreciate by more than 5.7% in that month. And then you're ready at that point in time to decide on your cash allocation once you've made your decisions as to which stocks you're going to use. So this chart on the screen right now will show you that if you had a $50,000 portfolio in 5 stocks, you would allocate $10,000 per stock. You take the current market value of the stock and divide it into 10,000, and that will tell you how many shares you can buy for $10,000. Now, since we need 100 shares per contract, we have to round that down or up to the nearest 100. So, for example, 306 is rounded down to 300. 588 is rounded up to 600. And that will dictate how many shares we're going to buy and how many contracts we're going to sell. Now we're ready for our trade execution, and we always use an online discount broker. If you recall, that broker must be inexpensive but reliable. On the left-hand side of the screen, you see the screen for the stock purchase, and on the right-hand side, you see the form for the options sale. Once we've entered our positions, we must manage them with exit strategies. All exit strategies start by buying back the option first. For declining stocks, we use the 20%, 10% guideline. We're willing to buy back an option premium in the first half of the contract cycle for 20% or less of the original option sale, and in the second half of the contract cycle for 10% or less than the original option sale. Sometimes we'll close our position mid-contract if the price of the stock has gone way up, leaving the strike price deep in the money. When that happens, the time value of the option premium approaches zero, so we can get out of our position at no cost to us or little cost. Use the cash to start a second position in the same month with the same cash, generating a second income stream. And finally, as we approach expiration Friday, if the price of the stock is higher than the strike price, we may want to use our rolling strategies to keep the same stock and continue to generate cash into our brokerage account using that particular equity. For more free information on covered call writing, feel free to visit my blog at thebluecollarinvestor.com/blog. Or I'd love you to join my mailing list where we continue to send you free information at thebluecollarinvestor.com/join_frnds.shtml. We also have a fine line of educational products which includes books and DVDs at thebluecollarinvestor.com/store.shtml. For our premium membership information, you can go to thebluecollarinvestor.com/membership.shtml, and I can be contacted directly at alan@thebluecollarinvestor.com. Well, I hope you found this series informative. My goal is to have as many average retail investors as possible become CEO of their own money and ultimately financially independent. And I hope this series is a stepping stone towards that goal. Thanks for listening. Take care, everybody.